Hi everyone, my name's Griffin Bridgers. Today I'm going to take a pivot from estate and gift tax and dig into an income tax issue that I found interesting, and if you practice in this area you may reach the same conclusion, and that's really dealing with the character of gain on the sale of LLC interests or even in a partnership interest, and how that was analyzed by a recent Chief Counsel Advice Memorandum 2023-09-015. Now, before we get started, I want to remind you this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So diving in, what's our backdrop? Typically, when we're looking at partnership or LLC interests, to give you a little bit of a history lesson, there's been a long-standing tension under state law and even under tax law as to whether when you own a partnership interest, is it more in the vein of like a tenant in common interest over all the underlying partnership assets, or is the partnership interest itself respected as its own form of property, more like an equity interest like stock? And a lot of states and the Internal Revenue Code reached the latter conclusion, that a partnership or LLC interest is more in the vein of being stock or an equity interest. And usually, stock or an equity interest is treated as a capital asset. So if you hold it for more than 1 year and then sell it, your gain or loss should be long-term capital gain or loss. And we contrast that with an amalgamation of underlying partnership or LLC assets where you'd have to dive into each of those and look at what portion of the purchase price was allocated to each. So Code Section 741 gives us the general rule that partnership and LLC interests are typically treated as capital assets. However, that's not true across the board. You still have to look through the partnership or LLC. And when I say LLC, I'm saying an LLC taxed as a partnership, but you typically have to look through to look for what's called hot assets under Code Section 751. So what 751 does is it says when a partnership sells a hot asset, or when there's a deemed sale of a hot asset, maybe due to the sale of a partnership interest, it will be ordinary income. So what is a hot asset? Typically it's going to be unrealized receivables, inventory, and what's counted in unrealized receivables is a recapture of cost recovery deductions, whether it's depreciation or expensing or amortization or whatever the case. So if you sell a partnership interest, then part might be long-term capital gain, but the other part that's attributable to hot assets will be ordinary income usually. Now, against that backdrop, this Chief Counsel Advice memo I mentioned, 2023-09-015, looked at a situation where perhaps we don't look through to hot assets versus capital assets in an underlying partnership. Instead, could there be a case where LLC or partnership interests are given ordinary income treatment despite what Code Section 741 says? In particular, might that apply if, for example, you're in the business of selling partnership or LLC interests? And the answer was yes. Like I said, this memo really involved the sale of syndicated conservation easements, which is a little bit beyond the scope of what we're going to discuss today and is ancillary to it. But I mentioned that the syndicated conservation easement has been the subject of a lot of consternation and tax abuse, in that the investment is usually touted as being less than the ultimate charitable deduction that could possibly be passed through to investors. So that's its own issue we're not going to dive into here. Instead, we're just looking at, in this limited sliver of an example of syndicated conservation easements, whether the promoter's sale of LLC interests as part of the investment of syndicated conservation easements would be subject to capital gains treatment under Code Section 741. And ultimately, the IRS Office of Chief Counsel concluded that it was not, that Code Section 1221A1, which says that property held for the ordinary or in the ordinary course of trade or business for sale to customers is not treated as a capital asset, that code section would override code section 741. So that in this case, we don't have to look through at hot assets. Instead, we just give a blanket approach to treat the entire LLC interest in this case as being an ordinary income item and not a capital asset. So there was an 8-factor test cited by the IRS from a prior case to determine whether you have property held for sale to customers in the ordinary course of a trade or business. And I'm not going to dive into those factors in particular, but one pivotal one I found interesting, and this is a helpful fact here, is the last one, which is the use of sales proceeds. Once that interest is sold, how is it used? And if it's used to acquire more of the same property for subsequent sale to customers, then that tends to show that this was not a capital asset, but instead was property held in the ordinary course of trade or business for sale to customers. And that's exactly what happened here. Since the promoter used the proceeds to acquire more land to syndicate more conservation easements, that was a controlling fact here that really tipped the scales, I think. And also, I think it's helpful to note that the IRS Office of Chief Counsel found that the sale of interest wasn't separate and apart from the promoter's activities of acquiring land and obtaining charitable conservation easements, which is really what they tried to promote as their primary activity. And ultimately, what was found is that, the entire land acquisition and charitable conservation easement process was really ancillary to the primary business, which was investment and promotion. So the sale of interest was, in other words, closely geared towards the investment and promotion business side of things. So with this backdrop, there was a little bit of a confusing analysis under this Chief Counsel Advice Memorandum in terms of how the IRS Office of Chief Counsel alternatively tackled the question of whether Code Section 751 applied. And ultimately, they refused to take that look-through approach to treat this like it was the sale of hot assets under Code Section 751, instead preferring to take the Code Section 1221 tack. So, if they had gone the hot assets route, what they could have said is, ultimately, what's held by the LLC is land that's intended for use in the sale to customers, which would in itself make it a hot asset as inventory under Code Section 751. But the IRS said that really the analysis is at the level of the LLC interests themselves and not of the land, because there was no evidence that the land itself was the inventory. Instead, it was the LLC interest in the LLC that held the land that was indeed the inventory. And that LLC interest didn't necessarily rise to the level of being a Code Section 751 hot asset, but it did fail the test under Code Section 1221A1. So, while this is not binding guidance, this memo should give pause when you're undertaking any income tax analysis of what's happening if and when LLC or partnership interests are sold. You can't just stop at Code Section 741 and assume, okay, it's a capital asset other than the hot assets under Code Section 751. Instead, you have to first analyze, looking at our 8 factors or whatever, is it possible that Code Section 1221 could apply to exclude this interest from the definition of a capital asset? Could this be more of an inventory item or an item that's being held for sale to customers in the ordinary course of the seller's trade or business? And I want to emphasize this narrow scope here that, even though there might be utility outside of syndicated conservation easements, I want to emphasize this memo only really applies to pass-through entity interests that are taxed as a partnership and not necessarily to corporate shares, particularly to C corporation shares. Typically, those are going to be treated as capital assets, but I could foresee, that maybe stock, especially in an S corp, could get this same type of treatment and analysis. So I still think there's some utility in analyzing a stock sale, whether it's a C Corp or an S Corp, from the perspective of whether Code Section 1221 might apply. Now, 1221 probably wouldn't apply in the C Corp area because you have the general utilities doctrine underlying the C Corp, so that you'd have gain at the C Corp level anyway for that type of asset. But S Corps possibly could be a different story. I don't know, but stay tuned. As always, if you're a tax or estate planning practitioner and you have questions or topic suggestions, you can reach out to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. And if you enjoy my content and you'd like to engage me as a speaker for your upcoming event, you can also reach me at that email address as well. But I thank you for joining me for this video, and I look forward to seeing you in my future content.